Hi everybody, my name's Kate Greenoff and I'm the R&D Director at Jeffreys Henry. This afternoon we'll be spending some time going through the R&D legislation and some various technical aspects of the R&D scheme. So I appreciate some of you already aware of the background of R&D, so apologies for covering old ground. I thought for those of you that are completely in the dark about the scheme, I thought it would be a good place to start would be to cover a bit of the history of the scheme. So the R&D scheme was introduced in 2000 and it was introduced as part of the government's plan to encourage spending on innovation in the UK. There's been a number of changes over the years and HMRC have made the scheme better since its introduction by taking certain measures. Some of these measures include increasing rates, previously removing the PAYE and NIC cap, and bringing in the large, and which is now being replaced by the REDEX scheme. Unfortunately, HMRC's view is that the standard of claims has dropped, and this has led to increased scrutiny around R&D claims. So there's been a number of changes in the PCRT, and for those of you, just to confirm what that is, it's the professional conduct in relation to tax guidance over the years. Recently, some representatives of the CIOT have attended a workshop with HMRC in advance of the preparation and publication later this year of 2 consultations on aspects of raising the standards in the tax advice market. So it comes as no surprise that there's been some further changes to the R&D scheme, and this reflects the government's tightening of the framework around the R&D relief. So some of these changes include the reintroduction of the PAYE and NIC cap for SME payable credit. This is similar to the cap that was abolished in 2012. It's been recently reintroduced in a slightly different format, and it's effective for companies with accounting periods beginning on or after 1st of April 2021. So what this cap does, it limits the amount of SME payable credit that a company can reclaim to £20,000 plus 300% of the PAYE and NIC bill. There's some exceptions to the cap, but it's likely there's going to be a number of companies who find themselves in a position where repayments arising are less than they were expecting because of this cap. So I've just gone through some other changes in terms of the our R&D scheme. So the good news is that for software companies, eligible software costs have been extended to include data and cloud computing costs. Data storage costs will also be included, as will work on pure maths. Unfortunately, with the good news comes the bad. So there's been some changes in terms of the R&D activities taking place abroad. So currently, companies can claim for subcontracted activities, and it doesn't matter where those subcontracted activities take place, so it can be anywhere in the world. The Revenue are keen to bring the R&D scheme back within the UK, and as such, they're making plans or changes, sorry, to reflect that. And those changes reflect what companies can claim for these subcontracted activities, and it's likely that companies will only be able to claim for subcontracted activities taking place in the UK, and there will be some key exceptions to this. And currently, we're just waiting to see the tax legislation that's being drafted. Other changes are likely to include the fact that claims must be made digitally, and to include details of qualifying activities and costs. All claims will need to be signed off by a senior named officer at the company and also have details of the agent submitting the claim. Also, companies may need to inform HMRC in advance that they plan to make a claim, and it's likely that this notification will be done via some way of an online portal. So what is the general qualifying criteria for a company to make an R&D claim? So when the HMRC originally released guidance upon the introduction of the scheme in 2000, the meaning of R&D was issued in what was called the DTI guidelines. These have now been replaced by what is known as the BEIS guidelines. So R&D relief support companies that work on innovative projects in science or technology. And it can be claimed by a range of companies that seek to research or develop an advance in their field. The work that companies that qualifies for R&D must be part of a specific project to make an advance in science or technology. And it can't be an advance within a social science such as economics or within a theoretical field such as pure maths. There's also, the definition also includes companies making appreciable improvements to an existing process, material, device, products or services. So what does appreciable improvement mean? Well, there's no set definition, unfortunately, whether or not an improvement meets the appreciable test. Each project will need to be considered on its own merits, and improvements cannot be merely superficial cosmetics. So improvements can be any improvements such as efficiency, selling costs, or costs of the product. The project must also relate to a company's trade, either an existing one or one that is intended to begin based on the results of the R&D. Also, companies that are claiming must be a going concern. So this precludes companies from making a claim where they've entered into liquidation. So to claim the R&D relief, the company must have sought an advance in science and technology. And the other key point is that there must be underlying scientific or technological uncertainties. So what constitutes a scientific or technological uncertainty? So that's where your company are researching or developing something that isn't known to be scientifically or technologically feasible when you make or discover it. Your company or experts in the field can't already know about the advance or the way that you achieve it. So this includes where an idea of how the uncertainty may be resolved, but you have to go through a process of trial and experimentation to test the idea. There's also a further criteria, and that's in respect of the fact that any encountered uncertainty is one that cannot be easily resolved by a competent professional in the field. So this means, what does this mean? This means that the company should not simply be bringing itself up to the standard of the industry. One way of evidencing this is to include details in an accompanying report of any directors or staff that may have relevant experience or background. So here I've just listed some examples of industries undertaking qualifying R&D. So I've listed the software industries are quite common, lots of different areas of software that you could potentially look into making a claim for. Engineering, that's normally quite a strong one for R&D. Also life science, pharmaceuticals, manufacturing and farming. And so some examples of R&D claims that I have submitted over the years include claims on new strains of wheat. There was a claim that I was involved in terms of a company making a drinks machine. Also a claim that I was involved a company that was building a tar recycling machine. There could also be R&D found within construction companies, such as developing innovative methods of construction where the building doesn't ordinarily lend itself to this. So there's many different types of industries where R&D could be undertaken. It's not always in the most obvious areas that people think of. I think there's a common misconception that R&D claims are only for companies that have laboratories or staff in white coats. So what types of questions and what types of things do we need to look at considering? And I've made a list of questions that you or you could ask your client. So, for example, are you producing a product or a service? From the outset of the project, was it certain that you could achieve the advance that you sought? Are you trying to improve your product or service? Were there any standard technologies, processes, or off-the-shelf products that you or your client could use? And why could you or your client not use these? Did anything you try fail? Did you undertake any trials or testing? Do you have any test results or reports that you could use? One important key point to note is that just because a project doesn't succeed doesn't mean that it still cannot qualify for R&D projects. So potentially the companies can make claims for R&D on aborted projects. Often I tend to find that in the first few years of a claim, it's difficult to review and remember the detail of the project. And it's not often that details can be readily available. to support the claim. So it's always worth suggesting to clients that making some notes, or making notes as you go along as to what you've been doing or the company's been doing, and also asking staff and employees to get involved in this process. It's probably worth you thinking about keeping a folder of reports and documents or emails that have been exchanged, just to serve as memory joggers. So what is not R&D? I've listed a couple of things that are not R&D. So copying is not, generally speaking, R&D unless you do not know that you're copying. So there are circumstances where two companies can be both working on the same project but not know they are working on the same project, and the details of this aren't readily available. And in that case, both the companies' projects could qualify for R&D, providing the relevant criteria is satisfied. Using standard methods or processes is not R&D. That's why it's important to benchmark the product or processes that you are considering. And by benchmarking, we mean considering what technology is already out there. Cosmetic or aesthetic changes, generally speaking, is not R&D. However, this can be a grey topic. So an example of this would be to change the colour of a product or make straightforward design changes. However, if work to create scientific or technological uncertainty requires the application of science or technology and resolving scientific or technological uncertainties, then such a project could be R&D. There is an example that HMRC give in their guidance, and that's in respect of a company that are seeking to make a new water-breathable fabric, where initial testing shows that users do not like the shiny appearance of the fabric. This results in the company investigating variants of new fabric, which require significant changes to the material's weave and physical structure. And in the manuals, this project is given as an example of qualifying R&D, because there is scientific and technological uncertainty as to if the desired characteristics can be achieved. Minor improvements are again not R&D, so this can include things like fault fixing and small minor tweaks. Often a client may say that they have made a particular item and then developed a range of products around that item. Questions I would be asking here is, have they simply tweaked the existing technology and really applied it with minor changes, or have there been fundamental changes in the process or building bricks that have gone into these subsequent products? So once we've looked at whether or not the company satisfies the qualifying criteria, we also need to look at what types of qualifying costs the company can claim. So there are certain categories of qualifying costs that a company can claim in respect of its R&D expenditure. So the first category of qualifying costs is employee costs. So what does it cost the company to employ somebody? And that is a cost based on their gross salary, Class 1 employers' national insurance contributions, and also employer pension fund contributions. Generally speaking, you can't claim for staff benefits such as private healthcare and gym membership. However, you can claim costs for travel, providing that that employee has expensed that cost back to the company, i.e. they've incurred it themselves, and that the aim of the travel cost is in respect of the R&D activity. Activity that is indirectly relevant to the project or which indirectly supports a project can also be eligible for relief. So, for example, time incurred by a specific R&D manager in respect of training or bringing in somebody for the R&D project could potentially qualify for R&D. Another category of qualifying costs is externally provided workers. So externally provided workers are workers engaged by the company through third parties. So this can be, for example, agency workers supplied on a temporary or one-off basis. There's certain qualifying criteria that must be satisfied to enable the cost to be claimed under this category. So the criteria is that the worker must be an individual and they cannot be a director or employee of the claimant company. And the worker services are supplied to the company through the staff provider. So a common situation is where you will find that you have a director employed by a group company. And because of the specific rules around this, that director cannot be claimed as an externally provided worker cost. However, there could be a case where the director's costs could be claimed on the subcontractors. For externally provided workers, there is a cap on the amount of expenditure that can be claimed, and that's 65%, and that's for an unconnected externally provided worker. For connected externally provided workers, it is possible to claim up to 100% of the cost, and that would require that agent disclosing their element of profit, and in some cases signing a connected party election. A further qualifying category is subcontractor costs. So companies can claim 65% of the relevant cost of using a subcontractor if the parties are unconnected. Alternatively, if the company and subcontractor are connected, or indeed deemed to be connected, then 100% of the relevant costs can be claimed. The benefit of making an election is that you can claim more than the 65% of the costs, subject to the company and the subcontractor jointly electing to do that. So some further categories of qualifying costs are software costs. So companies can claim for software licenses, for software used for the R&D, and a reasonable share of cost of software partly used in the R&D activities. Unfortunately, the revenue guidance around this is very grey. I've already mentioned that there's some welcome changes being introduced in terms of the extension of the definition of software, which reflects the way in which software costs are incurred by software companies. And just to recap on that, that's going to extend the definition of qualifying software costs to include data storage, cloud computing, and data sets, which is often a significant cost for many companies. Consumable items. Companies can claim for the relevant proportion of consumable items used up in the R&D. So this can include materials costs, utilities such as light, heat, and water rates. So in terms of consumable costs themselves, this is in respect of items that are transformed, and it cannot include costs of something incorporated into a product that is later sold. So it can include costs of prototypes, for example, and costs of consumables used within testing and production trials. One important point to note is that it does not include costs of renting or use of home. Clinical trial volunteers is another cost that can be claimed by companies for payments made to any volunteers taking part in clinical trials. So I've made a list of some costs that are generally not able to be claimed. So companies cannot claim for the production and distribution of goods and services. Can't also claim for capital expenditure. There's separate rules regarding companies incurring capital expenditure, and there are separate allowances under what's called the research and development allowances. You cannot also claim for the cost of land, nor the cost of patents and trademarks, nor rent or rates. So what types? So there's two different types of R&D schemes. So the first scheme that I will cover is the small and medium-sized enterprise scheme. And there's certain criteria that a company must satisfy to be able to claim under the scheme. So the criteria is that the company and perhaps companies in the group must not have more than 500 full-time staff, and it's either no more than 100 million euros of balance sheet, and that's for gross assets. Sorry, that's turnover, just to clarify. So the 100 million euros is for turnover, and the balance sheet assets, which I refer to are the gross assets, must be less than 86 million. So when you look at the limits, you look at the balance sheet end date to see if a company satisfies these limits. There's also a year's period of grace where a company can have 1 year of being large, but it is only in the second consecutive period that they actually do not satisfy the criteria for the SME scheme, that they would fall into the what's called the REDEX scheme, which I will come on to. So just to give an example on that, in year one, a company is large, but providing it was not large, in the previous year, it can still be an SME. If the company has grown organically, then in year two, it can still be considered small if it satisfies the relevant limits. However, if in year two the company fails the relevant limits because of the staff count or the turnover balance sheet, then it is the second year that that company would fail the criteria and therefore need to look to see if it can claim within the REDEX scheme. I briefly mentioned about companies or groups of companies. It's important to note that when looking at the criteria to see whether a company fits within the SME rules, you need to look at the groups and also definition of linked and partnership enterprises. So a linked enterprise is where one company is controlled by another, and a partnership enterprise is where one enterprise holds 25% or more of capital or voting rights in another. So there's certain specific rules around these, and it's important just to consider these rules and the fact that it's not just group companies that you need to consider. So the practicalities that it can often be quite difficult to establish a company's group position, or indeed any partnership enterprises, as I've just mentioned. HMRC do recognise this, and the company can make a declaration in good faith about its status regarding autonomy, partner and linked enterprises. And that's where it cannot easily determine any partnership enterprises. So just a point on partnership enterprises, there's some specific exclusions from the definition of a partnership enterprise. So those exclusions are listed in HMRC guidance and can include venture capital companies, public investment corporations, universities and non-profit research centres. Just coming on to the second scheme. So the REDEX scheme, where companies do not fall into the SME scheme, they may be able to actually claim under the REDEX scheme. The scheme is important for companies, and it's appropriate for those who do not satisfy the above limits, but also for companies who do not fall within the scheme because they are subcontractors or have claimed notified state aid on their projects. And this is often, we see this is relevant for companies that are claiming grants. They will need to consider whether they can fall within the REDEX scheme. So the REDEX incentive is in general based upon the same qualifying criteria as the SME scheme. The only differences between the REDEX scheme and the SME scheme is in terms of, firstly, the fact that companies generally cannot claim for subcontracted costs where they fall within the REDEX scheme. And just to be clear, that subcontracted activity is subcontracted to another limited company. So if there's some subcontracted activities to an individual or a university, for example, then the company should be able to claim those costs under the REDEX scheme. And the REDEX scheme was designed to allow larger companies with no corporate tax liability to benefit through a cash payment or a reduction in tax. And one of the other biggest differences between the REDEX scheme and the SME scheme is that the REDEX scheme allows companies to claim REDEX credits as above the line taxable income. An important point to note is that unlike the SME scheme, the REDEX credit is actually taxable on the companies, and if it is not included within a company set of accounts, it should be adjusted for and taxed appropriately within the tax computation. It is possible for companies to claim for both schemes. So it may be that a company has a project that falls within the SME scheme, but a project to which is claimed grant or state aid on, and that project will fall within the REDEX scheme. The relevant criteria can be quite technical, so it's always important to get advice first about this. So how is the credit claimed? So figures are submitted within the Corporation Tax Return Form CT 600 and also the supplementary pages. Submitting the tax return will trigger the claim. A report is submitted to support the claim. Now, currently, it's not a legal requirement for companies to submit a report. However, it is always our advice that to minimise and mitigate the risk of any inquiries, that the company should submit a report. And that report should detail why the company qualifies for R&D and should also provide an analysis of the R&D expenditure within the report. So if the return is submitted, it can be amended as long as you are within time limits. So an R&D claim can be made by submission of an original return, or it is possible to amend a return to include an R&D claim. The time limit for amendment or submission of a claim is 24 months from the end of the period of account. So an accounting period ended May 2020, the time limit for submission of a claim will be 31st of May 2022. So I've listed some benefits of making an R&D claim. So R&D is a valuable form of tax relief. The marginal rate of saving is currently 24.7%, but with the increase in corporation tax rates to 25% with effect from April 23, this rate of saving will increase to 32.5%. And this is as high as 33 1/3 for loss-making companies. I think there's a common misconception that this is some form of tax avoidance. R&D relief is a government-backed scheme and written into tax legislation. It gives a reduction in corporation tax liability, but also it's valuable for loss-making companies to obtain a cash repayment. And that's quite vital for companies in their early years of trading. It can make the balance sheet look healthier, and it can also give a valuable cash flow advantage, as I've already said, to companies in early years of trading. Money can be reinvested into growing your business, and it's also attractive for investors if there are plans to sell your company. So there's lots of benefits as can be seen from the above. So I've just listed some common areas and common issues that I've come across in terms of R&D claims. So these can be anything from not explaining properly and clearly in a report where the R&D qualifying activities lie, mistaking the types of costs that can be claimed for R&D, such as including marketing, advertising and branding costs. Also including types of costs for overhead such as rent. Companies sometimes don't consider what scheme they need to be in, and the fact that receipt of a grant that is government state aid may affect their qualifying criteria under the SME scheme. Also, it's important to consider the relevant cap for the payable credit. I sometimes see rules for connected parties not being considered. And another key point is that all qualifying categories of costs, with the exception of consumables, the costs have to be physically paid. So often we will see costs accrued in the accounts, and it's always important to ask whether or not that cost has been paid. And the revenues criteria is quite strict on this, and the cost should be paid by the time the claim has been submitted to the revenue to make that a qualifying costs. So thank you everybody for joining me today. I hope you found this webinar useful. I've listed my contact details there if there are any queries.